Mr. Kovacevich, pardon me, I'll go to you first. We asked a question in the intro, and I think it is the best question. What, if anything, is going to get these banks started again?
Well, I think the reason banks are where they are today is because of concern of slower economic growth, primarily because of the trade dispute. And if those don't get solved, you're likely to have an inverted yield curve, which some people think is negative for banks, even though if you go back to historical records, it's been okay. It hasn't been as good as a positive sloped one, but it is still had, the bank stock still increased during those environments. So the question I think that investors have to face is, are those going to happen? I personally think that there won't be recessions because of the massive stimulus that is going on in all countries and by all central banks, fiscally and monetarily. I think some sort of settlement will be done on the trade dispute. And when those things occur, you will not have an inverted yield curve. And finally, as you said, it's the worst sector at the moment. Banks are selling at by far the lowest PE ratio of any other sector, but they also have a great floor. It's called dividend yield. And most all banks have a 3% or so dividend yield. So you get paid to wait to see how all this is going to happen, and 3% is better than cash.
I hear you. But Bill, I mean, how long are you going to wait? There's a thought that these things are value traps. They're cheap by any standard you want to bring out there, but the stocks just don't move.
Certainly, I agree that they're cheap. And if you look at their valuation ranges post-crisis, they're trading at low levels, the lowest levels that we've seen. But quite frankly, I think their outlook is less compelling today than it has been at any point in the past decade post-crisis. And so, quite frankly, in our view, valuation is not a catalyst. It's a condition. And cheap stocks can get cheaper, particularly if numbers are too high and estimates need to be revised lower. And against the backdrop of decelerating growth, which is what we're seeing, decelerating CapEx growth, decelerating GDP growth, the consensus expectations for the banks that we cover essentially are somehow assuming a reacceleration in loan growth in 2019 after deceleration in 2017 and 2018, and an acceleration in fee income growth in 2019 after deceleration in 17 and 18. It's difficult for us to see how that reacceleration happens. Those inflections require catalysts in our view, and that's the biggest challenge that the bank stocks, in particular the regional bank stocks that we cover, face at the moment, is the lack of a catalyst that will drive a positive inflection in their growth from here. So yes, they're cheap, but they can get cheaper, I think.
Dick, I mean, you may be right. We may not get an inverted yield curve. We may not get a recession, but the longer interest rates remain at the levels that they are now, which is somewhat surprising that they've even moved lower, that's not good for the banks, is it?
Well, definitely the banks benefit from higher interest rates, but I still think the catalyst here is that the reason banks are where they are today is because there is a consensus belief, at least among investors, that we are going to have a slower economy. We may even have a recession. We may have an inverted yield curve. We may not settle the trade disputes. My point is, I think that is not, that's the catalyst. If those things don't occur, that is the catalyst that will not only help banks, it'll help the stock market in general. The whole stock market is down because of those issues.
I hear you, but I mean, when we were doing our biggest print on GDP not all that long ago, these stocks, and nobody was talking about a recession, and nobody was talking about a more near-term global slowdown. These stocks still didn't do anything.
Well, exactly. And I guess I believe that they are oversold, and they were oversold. And we'll find out. I would like to know what Bill thinks. Are we going to have a recession? Are we going to have slower growth? Is there going to be a trade dispute that doesn't get settled? And if he thinks those are going to happen, I think that's the catalyst for bank stocks and the whole market.
I don't necessarily believe those things are going to happen. But what I do believe is that we are seeing deceleration, and as a result, negative revisions are likely. And where estimates go, these stocks tend to follow. And so I think the catalyst is we need to see numbers stop coming down. And the problem is that in a decelerating growth environment, we have estimate cuts. There's a wave of negative revisions we think that are coming when banks announce fourth quarter results early next year. And negative revisions to 2019. We'll be getting negative revisions to 2020. And then there's questions about the pace of deceleration. Is that going to accelerate and therefore lead to further estimate cuts? And once we have clarity on when estimates stop coming down, then we can start to talk about, okay, is there going to be a reacceleration in EPS growth? And that's when I think you can buy these stocks, and when multiples stop compressing. Until then, stocks can continue to get cheaper, I think.